Greetings, everybody. I think a number of people are still logging in, but I just want to welcome everybody here today. I was reminiscing with one of our members who was reminding me that these used to be small dinner sessions in New York with about 25 people. I think today we have over 180 people signed up for this meeting, and dinner is not going to be served, I'm afraid, but we're delighted to have everybody here today. And I'm sorry that this has to be a virtual session, not a live one, but we're hoping to, as the vaccine is more widely distributed, that we might be able to get back to a face-to-face session sometime soon. We have a great lineup today. We're going to start with, we brought back Congressman Hill from Arkansas, who's on the House Financial Services Committee, to talk to us about what's going on the Hill. We have our great member, Mike von Konyenberg from East Hill, who's going to give us a capital markets overview, real estate capital markets. And then our very own Michael Billerman is going to interview Brian Kingston from Brookfield to give us a sense of where investment activity is going. And so we're going to try and make this as interactive as possible, given the constraints that we have with so many people. But why don't we jump right into it here and start with Congressman Hill, who may not need much of an introduction, but I just want to give a brief overview. He's represented Central Arkansas in the House since 2014. He won re-election in the 115th, 16th, and now the 117th Congress. He serves on the Republican leadership team for the House Financial Services Committee and ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, and the Subcommittee of Investor Protection, Entrepreneurship, and Capital Markets. He also serves on the Congressional Oversight Committee for the CARES Act, so has some good insights there. And he's a member of the WIP team on the U.S.-Mexico-Canada Agreement. He has an illustrious career in banking, Delta Trust and Banking Company, which he established. It was headquartered in Little Rock for many years until it was sold to Simmons First National Corp. And worked at the Treasury Department under George H.W. Bush, and was on the Executive Secretary of the President's Economic Policy Council at the White House. And we're very honored to have him here today. I just want to start by thanking you, French, for all your good work on the unprecedented efforts, really, to address this economic crisis that's grown out of the COVID-19 crisis, and working to really kind of try to address the hardships faced by American businesses, banks, and real estate in particular. With all that we're doing here, one of the provisions that was in the lame duck relief package was TDR provisions, which we can get more into, which you were helpful on, and the PPP extension, as well as rental assistance. But I think many of us who work regularly in the Capitol were kind of horrified by the attack on the Capitol on January 6th, and maybe we could just start with that. You were up there and you witnessed all of that, and maybe we could just start there and kind of work backwards, if you would. So, ladies and gentlemen, welcome, French Hill.
Well, Chip, thanks for having me, and Jeff and the Real Estate Roundtable team. It's great to be with you again. You do terrific communications on behalf of our real estate community, and all of us on Capitol Hill are grateful for that work in keeping us up to breast of trends in the commercial markets. Yeah, January 6th to me was it was such a shocking day, an embarrassing day, and a humiliating day, I think, for our country to think that citizens of this country would violently break into the Capitol on a combination of malicious intent and, for some sort of a lark moment. I mean, I just don't understand it. And it was frightening to a lot of the members who were in the chambers at that time, and they have been severely traumatized for it. And we are going to pay, I think, a long-term price in terms of relations in the Capitol over that day. I think it will be used as a bloody shirt, no pun intended, to wave at, for many, many weeks to come. And I regret that for our country, because it's hard to focus on the tasks at hand, which are getting through this pandemic, getting this vaccine distributed, getting our economy back open so that millions and millions and millions of our citizens can get on with their education, their work, their health. So yeah, it was a horrific occurrence. But our whole year of 2020 has been filled with, I think, that kind of shock from the impact of the pandemic and the loss of hundreds of thousands of Americans from a global pandemic that hadn't happened in 100 years, combined with the deep-seated resentment and violence that broke out in cities all over the country, ostensibly over the murder and horrible outcome in the George Floyd matter, but continue in this country. And that sort of violence and resentment, either from the left or from the middle or from the right, it just has, it's depressing to a lot of our citizens. So I hope that we can all step forward together about tackling what we're on this call to talk about and what we are all dedicated to, which is getting our families, our businesses, our communities back into balance and back into a moving forward situation. So I think we will do a very, very thorough investigation of the background and rationale of those who chose to go from a rally and become criminals by breaking into the Capitol. I think that will be fully investigated in a commission type form, bipartisan commission form. I've co-sponsored a bill to do that. I think we'll look at the lack of security and the decisions taken by the sergeant at arms and potentially the decisions taken by the leadership of the House in terms of security preparation. All that will be looked at. So appreciate you having me today, Chip.
Well, it's great to have you here, and we really appreciate your perspective, serving both on the Financial Services Committee as well as the Oversight Committee. I think you have a great perspective, and I guess maybe we could get a sense from you about the new climate here in the 117th Congress. You've got obviously Democrats in charge of the White House, the Senate, and the House for the first time in 10 years. The margins are very narrow in both the House and Senate. What do you see as the focus for the committee going in as we start the new Congress here?
Well, I think generally, if Joe Biden as the president demonstrates leadership in some strategic areas and truly wants to unify and govern with a better tone and in a more centrist way, he has the ability to do that with a 50-50 Senate and a much more narrow House margin. And it's going to become more narrow as three members of the Pelosi conference are leaving the House here in a few days and going to work in the Biden administration. So I think this really rests with Joe Biden's preferred course of leadership, which is not fully on display yet, because he's going down the essentially, I would say, the Democratic sort of left of center checklist of things you're supposed to do when you come into the White House, which is disavow yourself of anything Donald Trump did and go down a list of things, reopening old battles from 6 years ago on Keystone and things of that nature. So we'll have to wait and see. I could be cautiously optimistic, Chip, on some big legislative areas where we could make progress that have been stalled. But I really think we need to just wait and see. And I think that tone will be taken by President Biden as to how that is used and where it's used. I have concerns. I think Janet Yellen, our new Treasury Secretary, in her confirmation testimony, endorsed a $15 minimum wage, endorsed raising the corporate tax rate, endorsed raising capital gain taxes. I think she's signed on to the climate proposals of the administration. So these are all expensive things that are not per se about economic growth. And I'm going to be looking at all these proposals and say, look, does this move our country ahead? Is it better than current law? And then two questions. Is it doing something to end the pandemic? And is it doing something that encourages employment, jobs, and getting the economy back open? That's sort of my rubric, my glass I'll look through. We have not organized the House Financial Services Committee yet. This is a committee work week in the House. However, there are no committees organized to do work. So I think we have our first opportunity perhaps to organize the committee and have a hearing next week. But Maxine Waters, I think, is going to be focused on expanding public housing, expanding assistance for low, moderate income families. She's going to be focused on mandated disclosures related to climate change in corporate America. And we'll have to wait and see what her other priorities are.
Well, thank you. I guess one of the provisions of the last stimulus package included an extension of the PPP, which has been helpful, I think, by and large, despite some of the hiccups and abuses, has helped small businesses and filled in some gaps that the Main Street program could never fill in. Have you got any thoughts about how to maybe even expand that program more and going forward? Do we think that that's going to be a possibility down the road?
Well, Paycheck Protection Program certainly has been one of the more bipartisan aspects of the CARES Act. We offered it. Millions of jobs were saved, including here in Arkansas. So it was a very successful program on its surface, as you say, despite a bit of a rocky start and some mistakes along the way. It was tweaked in June, and then it was tweaked again in December. The main issue I have about PPP is that it was blocked in August by Speaker Pelosi not allowing a tailored, more narrow crafted bill to get PPP flowing in September, October, and November. And I think that's one contributor to the bad job numbers at the end of the year in the small business sector, because they didn't have a second chance PPP in October, November, when our cases spiked, which were not predictable. But we told all along in the 40 attempts to move that bill on the floor that it was essential, particularly in our hospitality sector, restaurants, small business sector. So we've got it out. And now if you did not get one, you can get a first PPP loan. That's for the businesses with under 500 employees. If you did not have one in 2020, I think that will help some businesses that made it through the year, but then have run out of steam at the end of the year. And that could help them pay rent to their commercial landlord, their utilities, their pay for up to 24 weeks. And then the second chance PPP was included. So your revenues are off 25%. You have fewer than 300 employees. So it was a little bit more narrowly focused to a business still suffering that's a little smaller, and they could get a second PPP loan again for 24 weeks, again with that benefit to pay their rent, utilities, overhead, and keep people connected to work. That went into effect essentially December 27th, and those loans opened up around the 7th or 8th of January, and they're rapidly being made. So you'll see some capital injection in that rental payment sector and that payroll sector here, certainly in a big way in February, but even for the first half of January. Other things that were tweaked, I think, that spoke to some of the challenges in the hospitality industry. There was money set aside for people with a movie theater lease, a live music venue lease, people who depend on all the revenues from private motor coach travel for a sports team trying to go from city to city. So those were added. And then finally, you noted in the prep for this call, rental assistance was included for the first time, with a minimum of $200 million going to each of the 50 states, with those programs being administered by the state, but facilitating both a landlord or a tenant to apply. This is for a low, moderate income renter, tenant who has got serious impact from coronavirus. So I think those were good things at the end of the year. It's a $900 billion additional injection. And let me remind the listeners, particularly any listeners that are gung-ho for another 1.4 trillion or whatever President Biden's request is, we're at 4.8 trillion. Let me repeat that, 4.8 trillion of appropriated money since the last week of March to December 27th that's been approved by the Congress and the Senate and signed into law by President Trump to either fight the pandemic or get the economy open and support families hurt by it. 4.8 trillion. That's more than we spend in the entire fiscal year for everything in the federal government in 1 year. Medicare, Medicaid, the Defense Department, your favorite national park, the ag programs, veteran benefits. And so in 9 months, the Congress has injected $4.8 trillion. So when someone says, hey, why don't we wait and see how the $900 billion that we just signed into law on December 27th, I think, $917 billion to be exact, why don't we see how it impacts all the targeted categories, plus the rollout of the vaccine across the country before we turn right around and propose another $1.5 trillion of new spending. So I think people really need to focus on this instead of being caught up in the one-upsmanship on can we just spend more money without thinking through how we're supposed to try to spend that.
And well, another aspect of the package that you were very helpful on was this troubled debt restructuring that I think gives the banks and life companies a little bit of wiggle room for forbearance, and it also extended the CECL provisions both through the end of the year, which we thought was important in terms of just sort of buying more time for people to work out troubled debt without having the regulators criticize the banks. What's your view on the state of the banking system? It seems like, compared to the last recession, the banks are doing extremely well. And in terms of capital and loan performance, what's your take on the state of banking at this point? And do we see any cracks in the industry there?
Well, I think at this time, we're all listening to conference calls as the publicly traded banks report their earnings starting just a few days ago and through early February. I think that will give us a very good snapshot of the health of the industry across the country in detail, meaning there are various exposures, particularly in certain aspects of the business travel hospitality sector that are more hurt. The leisure hospitality industry, depending on where you are, appears to have rebounded and remained, very supportive. It depends on very much the state, the amount of the lockdown, the impact on whether restaurants are open or not open, all those sorts of factors. And so it's very spotty across the country. But generally, when you look at the top line of earnings from the biggest companies and the capital ratios, they were very, impressive, and their stock prices have reflected that. You've seen the regional bank index rebound here in the first few days of 2021, back up to probably where it was, a year ago, having slumped somewhat during the 2020 year. So at this stage, I think we're in a watching mode, but we're blessed that our financial services sector was well capitalized and well focused in order to take this blow. I think the TDR provision is a modest but helpful item, both for the life industry, as you say, and the commercial banking industry. CECL, I think less so, less materially helpful, more of a psychological help, perhaps. But most publicly traded banks obviously implemented CECL in Q1 of 2020. And while they had this extra year tacked on to this for regulatory purposes, I'm not sure it's a material benefit. But the TDR issue is. And I think when we get into the summer stress tests by the Federal Reserve for the bigger companies, the SIFI related companies, how they handle the stress test will be important as well. But let's remind ourselves, whether you're a financial institution employee or a borrower on this call, we experienced, as we implemented CECL in Q1 of 2020, we experienced the exact misery we hoped we wouldn't have to, since so much of CECL accounting by the robots at FASB is tied to the unemployment rate. So you can imagine when the unemployment rate shot up and we lost over 20 million jobs in a month, what planning for Q2 CECL loan loss reserve impact looked like. So we've actually had a tremendous live round fired as a stress test. And the final comment I would say is the capital markets, due to leadership over the weekend of second weekend in March by Jay Powell in cooperation with Jay Clayton at the SEC, our exchange leadership, really opened the door for access for both fixed income and equity markets in a way that's been exceptional and allowed a lot of companies to have access to the capital markets. So between PPP, a modest amount of help in Main Street, very, very modest, and then access in the capital markets, we've seen American business handle this pandemic really in an unprecedented. I'm not being rose-colored glasses, but I think we have to look back and say we've handled a horrible situation pretty effectively out in the private sector.
I will give you good marks on that. I think, obviously people are still struggling in many parts of the economy. Some green shoots and bright spots, but still trouble. One of the things that we've been pursuing for months, as you know, is this whole idea of filling in the gaps on pandemic risk coverage, business continuity coverage, which a lot of people had coverage for business continuity, but realized that pandemic risk was not covered. Caroline Maloney has a bill out there. We've proposed some changes to that. We have a policyholder coalition put together, and we're working with a number of different stakeholders to try to come up with something that it will work both for the insurance industry, who is very opposed to this type of thing. This risk is not something that they want to take on their books, and trying to figure out some way to create a federal program that's manageable. I just wondered if you had any views on that, or would care to have any candid comments on that issue.
Well, during 2020, we certainly had the controversy of trying to trigger somebody's business interruption policy and get a full payout based on either the government shutdown in their state or the pandemic, directly, meaning their actual employees were ill from the pandemic, or obviously in a major way in a lot of places, both the pandemic and a government order to close your business and send people to remote working. In my view, the right way to handle this, and we've had a modest amount of hearings on it. I'm not on that subcommittee, but we've had a modest amount of hearings on it. I think Congress ought to do robust due diligence and hear from both insurance underwriters as well as the business community, and really determine after the fact, what is a course of action here going forward. And look at all the things that we're learning about how to better plan for and execute on a public health crisis like this. Many of us in the private sector believe that a catastrophic cyber event was maybe potentially the most likely impact on our business. And we tried to create offsite redundancy, additional security, hired additional people to have a much, much, much more robust IT and data protection regime. And we had a head fake. Well, we certainly all have cyber attacks every day in our businesses, and certainly at the House of Representatives, we are a prime target for bad actors, domestic and foreign. This pandemic, I think, as I've said, I've quoted Warren Buffett many times on this, I think we were caught at low tide with no bathing suit on as it relates to this public health crisis. And we need to really think in the private sector and the government sector what we need to do going forward. One of those things is what's realistic about business interruption coverages and something of this nature.
Well, thank you. And in the interest of time, we're going to have to shift back to the capital markets. But Congressman Hill, I hope you'll stay on, and if you'd like, and feel free to jump in with questions, and we certainly may, we get your views going in as we advance the call here. But I want to welcome Mike Van Kunyenberg, who is always welcome and been a stalwart member of the committee here for many years, and who is president of East Still Secured, and has kindly agreed to join us once again to offer his view of the real estate capital markets. And I will say, Mike, I know we talked about this sort of jokingly about whether or not people really still wanted to hear from you, but I can assure you they do. That it's a very you guys have great insights, and I think it's a great way to combine a lot of great information into a short period of time. So with that, I'll turn it over to you, and we'll get started.
Good morning, everyone. Great to be with you. Hopefully we're doing this in person soon. We always like to kick these off with some of the questions that we're hearing from people in the around the community around what is the questions that they're thinking about, and what are the things that people are talking about. And I think the first question is, with the election settled and with the vaccine approved, albeit a bumpy rollout, how fast do we see net new demand, particularly in the sectors that have been most impacted: office, retail, and hospitality? The second question really is, with the reality of the whole world coming out of the global crisis at literally this exact same time, are we going to have this roaring 20s level of growth and exuberance? I think we're seeing some exuberance in the public equity markets. The question is that going to be really on steroids as the world recovers simultaneously? I think the third question, following up on Congressman Hill's, what are the lasting effects of significant repeated government intervention? Does this make us addicted to stimulus? Does it make us addicted to QE? And frankly, I think the Japan and the Eurozone are addicted to QE. I think we may be headed there ourselves. I think the fourth question is, who and what are the relative winners coming out of the crisis? And then it's interesting, you look at, why are commercial real estate performance relative to almost every other asset class, why are we lagging behind by such a wide margin? So some of the macro themes that I think are setting up that are pretty bullish, and I'll talk about what I think are more challenges. Obviously, I think we've gotten the election volatility done. We have the uncertainty resolved. We have the less chance of black swan events out of our political system. That has led to reduced volatility, which we see in the equity markets and the bond markets. It's also led to a significant expectation of additional government spending and additional growth. Projections of GDP growth this year, 6%. And we're starting to see that in some of the leading indicators, which we see increasing commodity prices associated typically with expectation of growth. We're seeing a steepening yield curve back to kind of, it's very low rates, but it's back to kind of a normal shape. Again, expectations of growth. And at the same time, even with these big expectations for growth, we're continuing to see very, very low base rates. Still, 110 on the 10-year. It's something that we never thought we'd be until the last 6 months. But even more surprising is even at these low base rates, because of the amount of money in the system looking at for a home, credit spreads have really tightened. And so we're seeing both low base rates and near all-time tight credit spreads. And that reality is making, pushing people to take risk, because on a real basis, after inflation, we are losing money holding cash. We're losing close to 2% per year purchasing power holding cash, and even losing money holding investment grade corporate bonds. So I think it's a very interesting setup to push the world into risk. The other thing that's pushing is the weakening dollar. Long term, I'm a little nervous about weakening dollar when all of our assets, by and large, and net worth are in dollar assets, but it's definitely creating a real further boost to investment in the U.S. And at the same time, now we have nearly every global sector at all-time highs.
No, now I can't switch it.
Except for commercial real estate values. The question is, do we have room to run in the commercial real estate space? So breaking down those points a little bit more, this is volatility over the last 4 years. We peaked in COVID. We're back to the levels we've been for the last 10 years. This increased expectation of growth, this is metals. We had the chart for lumber, other commodity prices now back, approaching 10-year highs, real expectation of growth along with that steepening yield curve. And yet with that expectation of growth, at the same time, we have a Fed that is all in. This is the Fed balance sheet over the last 20 years, nearly doubled in the last year. You think about the scale of that liquidity in the system. That had, along with coordination with the Euro, ECB and the Bank of Japan, have driven rates super, super low. We've now come closer to where the rest of the world was. I think it's fascinating to look at the Eurozone represented by Germany here, negative 70 to 75 basis points rates. As an example of what's going on in Europe, we're starting to do fixed rate office building financing, several €100 million type financings at that 50 to 60% loan to value level. And we're doing swapped out fixed rate financing in the 1 to 1.5%. So you see the power of these low rates leaking into the real estate markets. This is the chart of negative yielding bonds around the world. We were 3 trillion in 14. Post-Brexit, we're 8 trillion. Today, we're 17 trillion. Just keep continuing this push for people to have to find yield. And this is what we're talking about in credit spreads. So this is the last 10 years. These are credit spreads for high yield bonds. So quote unquote junk bonds, a double B, single B, and triple C. We are at all-time lows on spreads for junk bonds over treasuries, while we're also near all-time low for treasuries. So clearly just a real search for yield and a willingness to take risk to get that yield. And this is real returns in investment grade corporate bonds. So what is the spread over expected inflation that you've seen? And over the last 10 years, it's been 160. Today, you buy a AA corporate bond after inflation expectations, you're yielding negative. You sit in cash, you're yielding negative 1.5 to 2. So really the market's setting up to push people to find places to take risk. And this is the dollar, again, over the last 5 years, peaked after the last election, peaked in COVID. This is the dollar against other currencies. We're now seeing that drift down. That makes the U.S. assets cheaper relative to non-U.S. assets. It also, most importantly, significantly lowers the hedging cost to buy U.S. assets. And that's been particularly beneficial for people who have their money in Korea and people in the Eurozone. So this is just an example of hedging costs over the last 3 years for Korean investors. So you see that red circle 175. So in 2 years ago, January 2019, if a Korean account bought a 5% coupon in the US or a 5% cap rate, when they hedged it back to local currency, they lost 175 basis points per year. So they basically took a 5 to 3.25. Today, that's basically, a 5 goes back as a 5. And so that's why we're seeing increased demand for debt and equity out of Korea, out of Europe. These same things, it's much, much cheaper to own US assets and to hedge those assets. And so when we look again at the broader markets and how the relative performance have been of various risk positions, this is total return for the NASDAQ, for the S&P, which is blue, the Russell 2000 small cap stocks, which is orange, and total return for REITs, which is proxy for private markets as well, is the green. And this goes back to the last election. So you see, obviously, NASDAQ has been a huge winner. We all know that. Big companies, as evidenced by the S&P 500, did really well initially out of COVID. What's fascinating to watch is this decoupling between the Russell 2000, which again are smaller companies, more impacted by COVID, less smaller balance sheets. You'll see REITs, at the green line right up to COVID, we were kind of performing similarly. And then we performed similarly for the first few months of COVID. And then as people have moved back into a risk on, we're coming out of recession mindset, you see the real move in the Russell 2000 small caps. And you see REITs, we're still basically just treading water. So over that 4-year period, the total return in REITs is 17%. That's basically flat price and just the 4% dividend plus or minus for 4 years. So it's pretty fascinating, this underperformance. The question is, do we have a leg up from here? Major issue is clearly jobs. That is the big issue, and the discrepancy between kind of the haves and have-nots in the job market. This is total net job loss. We had 9.4 million jobs lost net last year. This is a 50-year slide, worst we've ever had. I think what's interesting is just constant churn. This is trailing 12 months of initial unemployment claims. So over the 20-year average, we have about 20 million people initially file for unemployment claims each year. That peaked at 30 million, the GFC, or about almost 80 million on the trailing 12 months. So this huge job churn has created uncertainty. And then this is the slide over the last year of unemployment rates. The purple is people with a high school degree or less, and the blue is people with a bachelor's degree or higher. You see this big difference, which obviously is another feeder for social unrest, for angst in the country, and for slow in terms of our recovery. So that's the big macro headwind I think we all see. In the debt markets, we've said this many times, but they could not be stronger. Every major debt provider, aggressively on price and very rational on underwriting. The U.S. banks, the non-U.S. banks, and the mortgage REITs have probably been the slowest to get back active again, but the need for net interest margin is really starting to push the banks into the market, both U.S. and offshore. And I think in terms of the cost of that capital, it just keeps coming down. This is the break-even rate for conduit CMBS 10-year paper. So 2 years ago it was 388, a year ago it was 257, today it's 185. This is basically where AAA to BBB, the average yield of bonds that are issued off of CMBS conduit deals. And you're seeing this in the direct lending market, where we're seeing in the single borrower, single asset CMBS market pricing 10-year fixed on moderate leverage at 2.5 to 3. We're seeing some life companies get into the 2s. We're seeing a lot of debt easily done to the 3s, and now we're rarely seeing something in a 4. So huge push. Seeing that in REIT debt pricing, very, very tight. These are the last 3 months, very low yields. Simon 10-year paper, 220. Public storage 5-year paper there on the left at sub 1%. And now we've got a new financing vehicle in our market, the ABS financing, which really is available for diversified portfolios from single family homes to diversified portfolios of credit leases. But in the best case situation, you're seeing things being able to done at 90% loan to value at sub 2, again, putting more pressure on yields and the need to find additional places to get incremental yields. So we're doing a lot more of these, which will continue to drive cost of capital down in our space. Let's look at transaction volume in the equity side of the house. This is U.S. transaction activity greater than 25 million. So sales and JVs in the U.S. of institutional assets greater than 25 million. So you see to the right 3 lines, 18, 19, and 20. 20, we were only down about 35% off the record year of 19. That kind of takes us back to 2013. Again, that's a testament to all the liquidity in the system, because when we went through the crisis in 08 and 09, volumes were down 80%. So thanks to the liquidity in the system, there's been a rational transaction activity, and the pipeline that we're seeing is at least as big as it was in January 2020, so a year ago. So forward-looking pipeline feels very strong. So jumping in kind of early successes and challenges at the property level, and just a macro view. So in the office space, and we've kind of put these stoplights, red, yellow, and green, just to kind of give you a sense of short-term and longer-term what we're seeing. I think it's interesting to see the newer quality. I think there's definitely going to be a continued trend towards newer quality. Newer quality, long-term leased office space continues to trade very well. We've got several transactions, 500 to $1.5 billion, that were in the 4.5 to 4 3/4 cap rate range. So people believe that, to have shared culture, shared consciousness, to train people, that particularly for back office functions, people are coming back to the office, and that if you've got a long-term lease in place already, that continues to price very well, particularly where the debt is. Continues to be a real focus on techtainment, studios, the intersection of entertainment and tech innovation, that continues to do pretty well. Obviously, a real focus on Sunbelt office, whether it's Dallas or Raleigh-Durham or Atlanta or Charlotte, Miami. That trend that we're seeing of migration has really helped those office markets. I think there's a real dichotomy feeling that front office comes back. People need to be in the office. I think the real question is back office. I think that the question is, do these repetitive type tasks need to be always done 5 days a week in the office, or does work from home? And then commodity and older product clearly has been a challenge. Logistics, basically on fire. The only place is a little bit slower is the business parks. But again, seeing cap rates down sub 4 in logistics and industrial. Residential, I think a clear view that we have been low on housing. And so we're seeing particularly suburban multifamily, Sunbelt multifamily, single family for rent, build to rent, manufactured housing. All of those really with winds at their back coming out of this crisis. And cap rates have many of the times dropping below 4. I think the question really is how fast we get people back to the city centers, back into the office. That's obviously been the most impacted, a city center multifamily, either driven by both people not being in the cities because they're working remotely, and by some of the social unrest and crime. So I think that continues to be a question of how fast does that come back. I do believe it comes back. I think younger generations want to be in the big cities. And in senior housing, clearly one of those ones that has been a question. Hospitality, drive-to resorts, we're now seeing price near, getting pretty close to past peak levels, because people recognize that that's coming back very quickly. Select service, being able to control the cost, that continues to pick up. We're starting to see renewed interest in fly-to resorts. Again, the expectation that with all the liquidity and money in people's pockets, that when people can travel, they're going to be traveling again. I think the next thing to recover after that is really destination convention. I think we're all tired of doing this type of thing on Zoom. I think the place that's got the most struggle is the city center full service business hotels. We've got real union costs, and you've got the question of, do we do more on Zoom? Retail, there's things that are clearly working in retail, things that are challenged. The alternatives, but it's life science, single family, data centers, self-storage, studios, cold storage, really on fire. In terms of pricing, I think one of the things we like to always look at is where are the public markets pricing and kind of talk about where they are compared to private markets. And what we look at in the public markets right now is the change in gross asset value, not change in stock price, but gross asset value since January 2020, so pre-pandemic to today. And so that's what those blue bars are, is the change in gross asset value. And then down at the bottom is implied cap rates off of 2019 NOI. So I think a couple of things. You see industrial, both in the private markets and the public markets trading very, very well. I think you move to that beige area in the middle. I think it's an interesting dichotomy between Sunbelt, suburban multifamily up 3%, probably in the private markets up 5 to 7, 10%. Coastal multifamily trading off 17% off of gross value. And again, you think about the quality of assets in the coastal multifamily REITs, that we don't see yet in the private markets. Same thing in the office markets, moving in that purple shaded area. Sunbelt down 20% in value, feels a little bit oversold. Coastal values down 30% in the REIT market, seems very oversold in our view relative to what we see on the ground in the private markets. I think the other thing to think about in pricing is this is kind of the inverse. I talked about how spreads over in risk assets like high yield bonds, junk bonds are at near-term lows. This is spreads expressed as cap rates, and we're near an all-time high. So a complete divergence between what's going on in other risk assets and what in terms of what those spreads are and the trends versus our assets. So some of the things I don't think we should underestimate, both positive and negative. I think I got to update this. I think I'm a trillion light on this based on what Congressman Hill said, but a huge amount of money in the system, both fiscal stimulus. The fiscal stimulus will be 25% of gross GDP, if not more. Just a huge amount of money floating around the system looking for a home. I think the other thing is that the power and duration of low rates. Once you get on this low rate train, it is hard to get off. Japan's been on it 13 and a half years. Germany's been on it 7.5 years. We're 1 year in. So this pressure on yield may be here for a lot longer than we expect. And that'll push people to take risk. This is yields on high yield bonds again, the riskier market at the lowest yields available. You see this in Europe. This is cap rates over the last 10 years in the major office markets in Europe. Europe is kind of 5 to 6 years ahead of us on this low rate experiment. That will drive cap rates down as well. And I think the other thing is going to drive people into alternatives, into things with recurring cash flow. We're seeing that strong interest. This is the REIT market in the US on the left. 62% of the market is in alternatives. The right side is NCREIF, the Odyssey funds, only about 12% in alternatives. And I think this continues to shift over the next coming years. But on the negative side that we shouldn't underestimate is this job loss. We shouldn't underestimate the likelihood of real tax increases, potential elimination of carried interest in 1031s. All could be a damper on the growth. I also don't think we should underestimate that new habits and trends that were accelerating in COVID will not likely all go away with the vaccine, like the migration trend, the work from home trend, business travel trends, e-commerce. So to wrap it up, this is a headline from 18 months ago. This was back when the 10-year was more like 2.25 versus 1. The world is continuing to kind of reel from this financial vandalism of low yields. And so that, I think, continues to set up a pretty bullish setup for us. We know what the early winners are. Those look like they are going to continue to be early. We know what have been most challenged. We're really waiting for the vaccine to see how to underwrite the more challenged product. Fed intervention is going to keep discount rates and cap rates low. It's really about underwriting the recovery and how fast return to work happens and what that looks like. And this need for yield should really continue to drive significant capital towards us, particularly as we have the vaccine rollout and we really are able to start underwriting net demand. So Chip, I'll turn it back to you.
Thank you very much, Mike. That was outstanding. And actually, a I think, a somewhat optimistic tone, given all that we've been through over the last few months here.
Money solves a lot of problems.
Yes, it does. And we appreciate it. I did get a couple inquiries about your deck, and I think we want to direct people to your assistant, Marcella Campbell, at M Campbell, CAMPBELL at eastdalesecured.com. If they would like a copy of the deck, they should contact her. Is that correct?
Yep, or drop me a note.
Or drop him a note. Yeah, and everybody knows how to get in touch with Mike. I'm not sure that we have any questions that have come in yet, but does anybody have any questions? I don't see anything on the chat function here. In terms of, I guess, real estate credit markets, it seems like, amazingly, unlike the last crisis, that things are in surprisingly good shape. Oh, and here is a question from Brian McDonald. Is your optimism from liquidity, or are you seeing strength in fundamentals? There's a good one.
Yeah, I think the optimism is definitely more driven by the liquidity and the likely speed at which I think we have a return to work function. I think it's also looking at we've got the fundamentals in certain sectors are doing quite well. I think if we I think the level of spending at the government level, when that gets fully through the system, that will really create net demand. Now, it's not going to offset these trends of movement from one area to another and some of the trends of impacting retail like e-commerce. But we do believe that it allows a recovery quicker, which leads to net demand, particularly for certain assets that are like newer quality office buildings that have been under pressure. We're seeing technology companies start to look at new space and advance that. So we think that will move the fundamentals faster than we think for the asset classes that are really working.
Another question's come in. What do you think the long-term, obviously everybody's been shifting over to doing these Zoom meetings and working from home. What do you think the long-term impact is going to be on urban office sector, after we get the vaccine widely distributed?
Yeah, I think that I'm not optimistic on suburban around urban cores, because I think people are going to come back. They're either choosing to move to Dallas or Austin or Nashville, or they're coming back to the urban cores and the big urban cores. There's not going to be I do not believe that there's, other than for true back office functions, that their ability to really work for an extended period of time and still grow your company from home. So our view is that that the Zoom environment is going to be very helpful. It reduces some of the business travel going forward, but it does not, as somebody said the other day, I've not made a single new client or new relationship during COVID. And I think that reality, both in the workplace and outside the workplace, doesn't get solved by Zoom.
Yeah. Following up on that, what markets do you think have the potential to be the next Austin or Nashville, for example? Are you seeing anything emerging there as a new office center or business market?
I think the life science growth that we're seeing in Raleigh-Durham, which is still obviously a pretty small market, is clearly something that we're focused on. I think Miami. I think they can't ignore the number of people that are going to split their time between New York and Miami, it feels like. So that's another place that we see some additional, that likely have, if they can continue to attract some of the names that are attracting, that creates an ecosystem to drive that forward too.
I got time for about one more question here. Is sort of from a global perspective, is the U.S. still the cleanest shirt in the hamper, quote unquote, in terms of international capital flows, whereas a large change in U.S. debt dampened that. And part two of that is you mentioned inflows from Korea. What about flows from Europe or Middle East?
Yeah. So the European flows are definitely picking up as well. And, we're seeing growth out of the Middle East as well. Again, people, a lot of capital looking for a home. I think, we saw China had more net investment last year than the U.S. I think this kind of separation of China and the U.S. continues to be a something to watch. I do believe that in the major, currencies of yen, euros, and dollars, the U.S., with the dynamic nature of the economy, is a place that money will flow to if it's not flowing into China. I do think Europe is a little bit behind us. There's, some people that are more bullish on Europe. I think, the U.S., with the dynamic nature of the economy and innovation in the U.S., my instinct is that in a year from now, the U.S. further accelerates relative to Europe.
Well, thank you. That is I think a good note to end on. And Mike, thanks so much. Always a pleasure to have you. And I think, as I mentioned, if anybody wants a copy of the deck, we can either contact Mike or we can relay back to his office any inquiries. We've been talking to the various authorities. I mean, initially about testing, which has been really anemic, and now about vaccine distribution. But we've got the space, and I don't know whether I see Congressman Hill has jumped on. Maybe you have some thoughts there.
Quick footnote. First of all, fascinating discussion, and thank everybody for their contributions. It's been very helpful to me. On this vaccine issue, it's going to get better as you look at AstraZeneca or the Johnson & Johnson vaccine. Some of them are one-shot vaccines. Others have much less rigorous storage requirements that you see in the Pfizer, which is 2 shots and minus 74 degrees storage times. So all that's going to make vaccine more available to more areas through more locations, because they're going to have much better, I think, availability for more flexible location standards. And I don't have any doubt as that production ramps up that those sense of partnership in locations will expand.
Thank you. With that, Mike, did you have any additional comments? I don't know whether I think you're still there.
Mike Billerman or Mike Piquet?
Mike Piquet.
I'm good.
All right.
This has been great.
Yeah, I think this is terrific, and we really appreciate this. Well, the whole thing I thought was terrific, and I've learned a lot. So, without, I don't see any other questions coming in. So, and I know we have a board meeting coming up. Oh, did you have French? Did you want to say something? I'm sorry. No. All right. Well, I hope that you all join the next programming, which is the State of the Industry meeting at 4:00 East Coast time, and we have some committee meetings tomorrow as well. Sustainability, tax, and Homeland Security will meet tomorrow, and we have a two-stage meeting this afternoon at 4 and then at 7. So with that, I hope everybody will tune in, and please let us know your thoughts and comments. And if there's additional questions or comments or programming you think we should be doing, please don't hesitate to let us know. Brian and Michael, that was terrific. Really appreciate it. And Mike, if you're still there you are. Yeah, terrific. And French, absolutely outstanding. So with that, I'll say good luck. Everybody stay healthy, and hopefully we'll be through this before too much longer.